Okay, hello everyone. This is Capitaland China Trust. First quarter 2024 business update stated 24th April 2024. Alright, let's go through the key highlights quickly. Alright, we'll start with the positive aspects. Okay, the 9 retail malls are doing pretty well. Alright, shopper traffic is up 17.4%. Tenant sales are up 12.6%. Right, both of these are year on year. That means they compare January to March 2023 to January to March 2024. Alright, and January to March 2023 is a significant time because that's where China actually opened up on 8th of January. That means to say in 2023 from January to March, the shopper traffic should be more or less the normalized China retail mall shopper traffic. And to get a 17% rise in shopper traffic on the normalized shopper traffic is quite a positive upside, right? Tenant sales is also a positive upside at 12.6%, right? Again, this is of the same period that we discussed earlier. Cost of debt has gone down this quarter, right? Last quarter was 3.57%, right? And I think the main reason why this has gone down is because they have converted some of their Singapore denominated debt into renminbi denominated debt, which has a lower interest rate. Right, so gearing has a more or less positive trend. On 30th September 2023 it was 42.3%, 31st December 2023 was 41.5%, and finally 31st March 2024, which is the most recent quarter, is 40.8%. Right, so you can see the general downtrend is gearing, which we are clearly happy about. Now we go on to the bad news. Right, the bad news is that actually their biggest logistics park, right, they actually lost the tenant, right, because of business closure, which I think means it went bankrupt, right? And that business park went from from an occupancy of 60.4% to 0%. So that business park is empty, and that I think is the logistics park went empty, right? So it is the logistics park that got issues, not business park. Apologies for the mistake, right? So the tenant in the logistics park, which happened to be the biggest logistics park, went bankrupt, and the whole logistics park is currently now empty. All right, so that's a bad thing. If we look at the revenue, all right, it has gone down for the new economy side by $9.3 million. Okay, I'm not sure how much of the bankruptcy of this big tenant has been included in this drop, because the worst case is that the tenant went bankrupt late in first quarter, and actually they contributed to very little of the drop in revenue. That means that second quarter performance is going to be worse, right? That means the drop is going to be worse, right? However, if the tenant went bankrupt earlier, or actually didn't pay rent in first quarter, right, then more or less the damage caused by this tenant is already included in this number of $9.3 million drop. Okay, I'm not exactly sure when this tenant went bankrupt and what is the whether or not this tenant paid any amount of money for first quarter, right? So I'm not sure if the full effect of this tenant going bankrupt has been factored into the drop in revenue for the new economy side, right? On a brighter aspect, okay, if we compare the retail side, right, the first quarter 2024 gross revenue contribution from 9 malls is actually greater than the first quarter 2023 contribution from 11 malls. So in 2023, they actually had 11 malls contributing this amount, alright, but they sold off 2 malls, and the remaining 9 malls have actually brought in more revenue than the 11 malls they had in 2023 in the first quarter, alright. So this amount has gone up by 2.1 million, alright. It's not very big because it's not fair to compare 11 malls with 9 malls, right? But the fact that the 9 malls still managed to outperform is a good thing, right? If they were to exclude the 2 malls that they sold, right, retail gross revenue actually would have gone up 5.7% year on year, right? So actually retail side is doing decently well, right? So revenue is up 5.7%, right? For NPI, yeah, we can have a look at NPI is actually down 7.7%, right? I won't be going through the numbers. Basically, you can see the new economy side actually dropped by 26.3 million, whereas retail side gone up by 0.3 million. But again, don't underestimate the 0.3 million, because this is comparing 9 malls with 11 malls lah. Alright, so anyway, overall NPI in renminbi is down 7.7%. However, right, if we look at in terms of SGD terms, right, which is more important because this REIT pays dividends in SGD, right, the MPI actually decreased by 11.8%, right, due to the depreciation of renminbi to SGD, right. So this is a big problem that keeps plaguing this mall because renminbi is weakening because the interest rate in China is not very high, and for Singapore we are sort of following the US interest rate, so our interest rate is higher. So that's probably why SGD keeps strengthening against renminbi, and it's not good for this REIT because their income is in renminbi and they have to convert to SGD before they pay us. So the numbers look quite bad. Alright, so MPI in terms of SGD terms actually dropped 11.8%, right? So net property income, if you want to be very specific, dropped by 11.8% and not 7.7%, right? So I did a projection for what this may, how this may affect DPU. Okay, of course this is not a very accurate projection because it's normally from MPI down to DPU they still can adjust the numbers a lot for things like paying off interest expense and maybe even capex. Okay, but I'm just doing a very rough estimate that let's say if I lose 12% of last year's DPU, right? So what will happen, right? So we look at the annual report for 2023, the DPU was 6.74%, right? So 2023 DPU 6.74%, I take 12% off because I just round 11.8% to 12%. So I get 5.93 cents dividends annualized, right? And based off the latest closing price of 67 cents, right, this REIT is giving 8.85%, right? But please note that this 8.85% is, I already take a 12% haircut off last year's dividends lah. Okay, then I further press the situation a little bit by removing the business park and logistic park. Roughly, again, I say this number is rough, right? I just look at MPI, roughly the new economy side is about 30% of net property income. So I take a 30% haircut off this 8.85% to just have a look what happens if business park and logistic park stop contributing, right? And the retail side only is the only part contributing lah, and the retail side will be contributing 6.2%. Alright, but this is clearly a very doomsday scenario lah, that is unlikely to happen lah. Okay, I don't think the business part and logistics part will stop contributing. Okay, but if you just look at the trend, it's a bit scary lah. So I just wanted to see what happens to retail side. Okay, so anyway, moving forward, we look at operational updates. Okay, you can see the retail side is still quite strong, 97.7%, right? To me, anything above 95% is a sign that there is strong demand for the property lah. Right, so market level is around 91.1%, so it shows that they are performing above average. Okay, business park, the occupancy is 90.2%. It looks great against the general market condition of 67.9%. However, there are a lot of headwinds for this business park because there's weak business sentiments and influx of business park supply entering the market. So firstly, there's not much demand. Then there's new business park supply entering the market, right? So it's sort of like a double whammy of bad events happening for this business park. All right, then logistic parks more or less experiencing the same issues. You can see they say, okay, I have secured that leases with key tenants for these two logistic park, but one of it, the occupancy is only 9.7%, right? This one is doing better lah, it's 99.7%. But we need to remember one of the logistics park is completely empty right now, and I think it's the biggest one, right? So they say they'll align rental rates with current market conditions to maintain competitiveness, and this means that likely they're going to offer cheaper rents. Okay, right? Balance sheet looks good, right? Total debt, gearing, and average cost of debt is down, right? Adjusted income coverage ratio has gone down to 3x, which is still acceptable in my opinion. All right, there's always this worry about exchange rate on gearing, primarily because most of their loans is in SGD and their assets are in renminbi. So if SGD strengthens against renminbi, right, the loans naturally just go up and then the assets go down, and then you have this gearing ratio automatically go up, right? So you can see every time the SGD strengthen 1% against renminbi, right, the gearing goes up by 0.36%, right? So this is something not very good for this REIT, right? But you can see that management is trying to mitigate this issue, right? You can see last time their SGD denominated debt was 80%. It has since dropped to 77%. Right, where did that 3% go? They have converted it to renminbi denominated debt. Right, so there are two advantages. One is to remove the exchange rate movement. All right. Number two is renminbi loans actually have lower interest rates. All right. So they actually try to stretch out the renminbi loans longer lah, because low interest rate is always good for the REIT. Okay. So this year not much debt left to renegotiate, 2.4%. So balance sheet wise, they should be quite okay. Right. So we move quickly on to the shopper traffic. All right. So and tenant sales. All right. To me, these results are pretty good because, like I said, when we look at COVID ending in 8 January 2023, it means that the grey area here, Q1 2023, is actually more or less normalized shopper traffic and shopper sales, in my opinion. So when you have a double-digit growth in terms of traffic and sales, that's always a very impressive result. Alright, and you can see that it looks like it's quite widespread. Food and beverages up 17.5%, leisure and entertainment up 12.6%, okay, supermarket up 14.2%. Right, so it looks like China consumer is recovering. Okay, and you can see this very big jump here, 58.6% for electronic vehicle sales. Right, so some of these could be, especially this part right, for the electronic vehicle sales, could be due to government incentives. All right, I think the Chinese government is actually offering their citizens incentives to buy green electronics or EVs. Right, this is to improve, I believe, the environmental sustainability ideals. Okay, so we look at retail occupancy. Okay, it's down slightly from 98.2 to 97.7%. All right, most of the malls are above 95% except these two. Right, so these two are just a slight worry. Okay, we look at the retail portfolio lease expiry. There's actually 40.3% up for renegotiation in this year. Okay, although this is high and looks a bit scary, but it could be a positive thing for the REIT because it just so happened that the retail side is doing well. Right, so hopefully this translates into even higher rental. Okay, the other side is the business park. You can see that just one look across, right, every business park has gone down slightly. Alright, so clearly the overall performance of business park in terms of occupancy has gone down slightly as well. Alright, and they admitted that there's new supply entering the market. Alright, so yeah, you can see that softer leasing demand, okay, and new supply added. Okay, so these are the headwinds that the business park is facing. Okay, very similar to the logistic parks. Alright, you can see that there's more space coming up online in 2024. Alright, that means more competition for tenants. Alright, so I'm not sure how long they're going to take to fill this empty logistic park. Right, so yeah, so this is the major issue right now, how they're going to fill this logistics park. Alright, so we'll just look at an estimate. Right, so just short while for business update. Right, so China economy actually seems to be doing well. It's up 5.3%. Right, they say there's resilient industrial activities, but doesn't seem reflected in the business park and logistics side from this annual report. Right, maybe strong service consumption is correct because the retail side is doing well. All right, then yeah, so this is just something to pay attention to. Right, the land lease of the retail malls, right, all have maybe about 20 years. Right, you see they all expire roughly in 2044. Right, so this 2024, you have about 20 years left. Right, whether or not the land use can be renewed after this time, right, which is underlined in red, right, remains to be seen. I think long time ago they said that it's likely that it's quite easy to renew these land leases, right, but that was pre-COVID. Now I don't know what is the real situation. You can see all their malls is roughly the same time. It's roughly 2044 to 2049, right, so that is the they lose the use of the land. Right, they have to then renegotiate with the government to see whether the government want to let them carry on using the land. Right, so given China's unpredictable government policy lately to businesses, right, this has to be a potential concern for investors. Right, so you can see the business park also has this issue, but some business park are the land is still very long lah, 2064 and so on, and you can see logistic park also quite long, right? So most of them are 2060, right? So logistics, but unfortunately it's the biggest underperformer lah. Okay, so anyway, just a short report from OCBC. I think that they have some insight into what's going on with the Shanghai Fengxian logistics park, right? So it's vacant following the business closure of former tenants. Management expect 3 to 6 months to backfill the space, right? And they may need capex. So number one, they won't collect rent for 3 to 6 months for sure. Then they may need to spend money to make sure this space is usable for the next tenant, and the rental revision is likely to be revised lower from 20 to 30%. Okay, depending on the quality of the tenant. Okay, so these are the things that I want to discuss today. Thank you very much for listening. Sorry the video is so long.